Every generation believes it is living through a moment unlike any other. New technologies appear. Old rules seem broken. Markets behave strangely. Certainty dissolves. Books that study economic cycles begin by challenging this belief with a quiet but unsettling observation. History does not repeat perfectly, but human behavior repeats reliably. And economic cycles are not accidents of policy or fate. They are expressions of collective psychology unfolding over time. The books that attempt to predict the future are often misunderstood. They do not offer timelines, dates, or precise forecasts. In fact, the most respected authors are deeply suspicious of anyone who claims certainty. What these books actually provide is something more subtle and more durable, a framework for recognizing where we are within a recurring pattern that has played out for centuries across different cultures, currencies, and political systems. At the heart of economic cycle literature lies a single uncomfortable truth. Prosperity plants the seeds of its own decline. As conditions improve, caution erodes. Risk tolerance rises. Leverage expands. Standards loosen. Each individual decision feels rational in isolation. Collectively, they create fragility. By the time the system breaks, the cause is no longer visible. It has been normalized. Books that examine cycles often begin with this normalization process. They show how optimism does not arrive suddenly. It creeps in quietly. Returns become expected rather than appreciated. Volatility feels unnecessary. Safeguards are dismissed as outdated. These are not signs of progress. They are signals of maturity within the cycle. Another foundational lesson across these books is that economic cycles are psychological before they are numerical. Data confirms what belief has already decided. Markets turn, not when statistics peak, but when expectations do. Confidence reaches a point where it can no longer expand. Fear reaches a point where it can no longer intensify. Prices follow sentiment, not the other way around. Debt plays a central role in nearly every serious examination of cycles. Credit accelerates growth early and magnifies damage late. Easy borrowing pulls future demand into the present. This creates the illusion of strength. Over time, obligations grow faster than productive capacity. When servicing debt becomes difficult, the system must correct. This correction feels sudden, but the imbalance was visible long before it mattered. Books tracing long-term cycles from empires to modern economies highlight how each era believes it has engineered away the past. New financial instruments, smarter regulation, faster communication. And yet, cycles persist. The tools change. The rhythm does not. This is not because people are foolish, but because incentives and emotions remain consistent across generations. Another recurring insight is that cycles operate on multiple layers simultaneously. Short-term business cycles unfold over years. Credit cycles stretch across decades. Demographic cycles span generations. Technological cycles overlap them all. Books caution readers against focusing on one layer while ignoring the others. Confusion arises when short-term noise is mistaken for long-term turning points. These books also stress humility as a prerequisite for understanding cycles. The moment someone believes they have mastered the pattern, they are usually positioned to suffer most from its reversal. Cycle-aware thinkers do not ask, "What will happen next?" They ask, "What tends to happen when conditions resemble this?" This shift replaces prediction with probability. Another powerful theme is time distortion. During expansions, time feels abundant. During contractions, time feels scarce. Decisions that could have been adjusted gradually suddenly must be made under pressure. Books emphasize that preparation during calm periods is the only reliable defense against forced action later. Policy response appears frequently in these discussions, but always with restraint. Governments and central banks can influence timing and severity, but they cannot erase cycles. Intervention often delays consequences, which can increase their eventual intensity. Books show that resilience comes not from trusting policy to save outcomes, but from designing systems that do not require rescue. Technology is often mistaken as a cycle breaker. Books challenge this assumption directly. Every technological revolution from railroads to the internet created extraordinary productivity and extraordinary speculation. Innovation changes what grows fastest. It does not change how excess accumulates or how correction unfolds. Another recurring lesson is that cycles are not evenly experienced. Those closest to leverage suffer first. Those with flexibility endure longest. Books emphasize that cycles are selection mechanisms. They reward patience, liquidity, and discipline. They punish overconfidence and rigidity. Importantly, cycle literature rejects fatalism. Understanding cycles does not mean withdrawing from participation. It means engaging with structure. Exposure sized for uncertainty. Expectations calibrated for volatility. Systems designed to survive error rather than require perfection. As readers move deeper into these works, something subtle happens. Fear softens. Headlines lose their power. Market swings feel contextual rather than personal. Understanding replaces urgency. The future feels less threatening not because it is predictable, but because its patterns feel familiar. These books also redefine foresight. Predicting exact outcomes is impossible. Recognizing behavioral extremes is not. When euphoria dominates language, risk is usually mispriced. When despair dominates narratives, opportunity often emerges. Cycle-aware thinkers listen for tone more than data. Another insight emerges around generational memory. Those who lived through downturns behave differently from those who did not. As memories fade, risk tolerance resets. This forgetting ensures cycles repeat. Studying history becomes a way to borrow experience without paying its full cost. Over time, readers stop seeking certainty. They seek resilience. They stop chasing forecasts. They build buffers. They stop asking when the next downturn will occur. They assume it will eventually and design accordingly. And this is where the story begins to narrow. Because once economic cycles are understood, not as random disasters, but as recurring expressions of human behavior, interacting with leverage incentives and time, the future becomes less mysterious. Not because it can be predicted, but because its rhythms can be recognized. The goal shifts from guessing outcomes to remaining solvent, flexible, and emotionally steady. As expansion gives way to contraction, and contraction gives way to renewal again and again, revealing that the real advantage lies not in knowing what comes next, but in being prepared for whatever phase arrives next, like learning to read the rhythm of change rather than trying to freeze it. And this is where books about economic cycles finally let go of prediction and focus on survival behavior and advantage. In the second half of these books, authors make a quiet but decisive turn. They stop asking what the future will be and start asking how people consistently behave when conditions shift. And from that angle, a powerful clarity emerges. Economic cycles do not punish ignorance as much as they punish rigidity. The people who suffer most are not those who failed to forecast correctly, but those whose lives and finances were designed to work only in one phase of the cycle. One of the most repeated conclusions across cycle literature is that certainty is the most dangerous asset in finance. During expansions, certainty feels like confidence. During contractions, it becomes blindness. Books show that investors, businesses, and governments that assumed growth would continue indefinitely built systems that could not bend. When pressure arrived, those systems broke. By contrast, cycle-aware individuals behaved differently. They did not attempt to exit perfectly or enter at the bottom. They focused on positioning. They reduced leverage when optimism was high. They increased liquidity when it felt unnecessary. They accepted lower returns in exchange for staying flexible. These decisions often looked conservative until they became decisive advantages. Another critical insight appears. Here, cycles reward those who prepare emotionally, not just financially. Most losses during downturns are not caused by price declines alone, but by panic-driven decisions layered on top of them. Books emphasize that people who had mentally rehearsed downturns were far less reactive. They expected discomfort. They accepted drawdowns as part of participation. Because nothing felt shocking, nothing forced irrational action. These books also highlight how understanding cycles changes opportunity recognition. During contractions, most people focus exclusively on loss. Cycle-aware thinkers look for asymmetry. What is being mispriced because fear is dominant? What assets, skills, or relationships can be built quietly while others retreat? The future winners of the next expansion are often shaped during the contraction, not after it ends. Another recurring lesson concerns patience with recovery. Cycles do not reverse overnight. Books warn against expecting immediate normalization. False recoveries, prolonged stagnation, and uneven rebounds are common. Those who rushed back into risk prematurely often suffered twice, once during the downturn, and again during disappointment. Cycle-aware individuals waited for conditions to stabilize rather than headlines to improve. These books also make a sharp distinction between resilience and opportunism. Not everyone should deploy capital aggressively during downturns. Survival comes first. Liquidity is optionality. The books stress that the right response depends on position. Those who preserved flexibility retained the choice to act later, which is often more valuable than acting early. As the narrative approaches its conclusion, a deeper philosophical realization emerges. Economic cycles are not flaws in the system to be fixed. They are consequences of human behavior interacting with time incentives and leverage. Attempting to eliminate them usually creates larger distortions. Accepting them allows for design. And this is where understanding cycles becomes quietly empowering. The future no longer needs to be predicted precisely to be navigated effectively. If expansion eventually gives way to contraction, and contraction eventually gives way to renewal, then the task is clear. Avoid decisions that require perfection. Build buffers that buy time and remain psychologically steady when others are not. So the lesson resolves without spectacle. Books that predict the future rarely do. Books that explain cycles do something far more valuable. They teach you how not to be surprised by patterns that have repeated for centuries. They reduce emotional whiplash. They protect judgment. And they allow you to remain engaged long enough for recovery opportunity and compounding to matter. If this reflection resonated with you, pause and ask yourself one honest question. Are your financial decisions built to succeed only if the next few years are favorable, or to endure if the next few years are difficult? That answer reveals whether you are betting on a forecast or designing for a cycle. Share what this made you reconsider. And if you want to keep exploring books and ideas that replace prediction with preparation and fear with perspective, subscribe and stay connected. Because the future does not reward those who guess best. It rewards those who stay solvent, flexible, and calm long enough to adapt.